Good afternoon, ladies and gentlemen. This is Jeff Alley. I'm a senior market analyst here at Oanda, Singapore, and welcome to the weekly commodities and precious metals commentary. Let's just crack straight into it. I guess the main news this week has been the lack of insight given by Miss Yellen and Mr. Draghi at Jackson Hole. This left the market a little bit disappointed, along with some more action from Donald Trump, President Trump, and saw a renewed selling of dollars across the boards, and this has been broadly supportive also of precious metals. This morning we saw North Korea do yet another missile test. This one was a much flatter trajectory and landed somewhere in the Pacific Ocean, but flew over the Japanese island of Hokkaido on the way, which understandably upset the Japanese tremendously. We saw a sell-off in Asian equities and a sell-off in dollar yen due to that today, and that was also giving a boost towards gold. As we look at the chart here with gold up on the top right-hand corner, we can see the last 2 days gold has, let's just move that out a bit, jumped substantially. 2 huge days in a row, rallying from 1292-ish all the way up to 1312. In the process, breaking that 1296, this huge thick line I've driven here, and also this 1301, which was the previous high. Excuse me. It's quite significant because now we've had a close. In fact, it started at the lows of its day and closed at the highs of its day. Sort of went directly to go, straight past jail. And in the morning session today, we've seen it push on again, moving directly to go, finishing in early European trading at least near its highs around the 1370 at the 1325 mark. We can see long-term support here, this ascending trend line, which formed an ascending sort of triangle or a wedge with this 1296 area. We've now well and truly closed above this level, and it's now up to gold to consolidate. The next target was actually around 1337. That is well and truly in sight at the moment, even after a couple of days, which shows you just what a good bout of risk aversion can actually really do for gold. If we move out a bit further, we have to go an awfully long way back now to see when gold was actually at these levels. Having said that, gold is moving into slightly overbought territories if we look at the RSI here, and so maybe, just maybe, ahead of that 1337, which is this next high point way back here in November of last year, maybe we just need to pause for breath for a little while. As far as this trend line goes, it comes in around the 1280 level that I've marked here today, and that will move up higher each day. But we can see we've had a nice consolidation here around 1280 to 1296 before moving higher, which would be a fairly healthy bullish sign. I don't think longer term bulls will get too concerned until we get down to this 100-day moving average, which today is sitting around the 1259 level. Let's move on to silver. Again, we've had this sort of ascending wedge or triangle pattern. And again, silver, which has actually lagged gold to a certain extent, has broken out of this top, which is around 1739. We've closed above it, and all the signs are today, in today's session, that we'll close above it again, marking 2 consecutive closes. In the meantime, we have cleared this congestion area here, which has been around each side of the 100 and the 200-day moving averages. So maybe silver is on the move at last. We can see the next line here is this previous double top, which is around 17.76. And way down below now, this support line, this longer term support line, which is this ascending trend line, that comes in around the 1681.25 area. So we really need silver to break back below that to sort of upset the bullish pattern that we've been seeing. As far as the RSI goes, it's moving towards the overbought, but it certainly isn't in overbought territory yet. So maybe silver has a little bit more room still to go, just looking at the charts. Popping over to platinum. So I've drawn a Fibonacci on this because we've approached some quite interesting levels there too. Now if I was to blow this up a little bit more, we can see this ascending trend line here that goes back to the start of July basically, has held most of the pullbacks and platinum on the way up, although it hasn't been a linear progression. We are now well and truly above this 200-day moving average, which held this pullback here around this sort of like 951 level, which I said last week was a very, very significant level now, simply because it held it so perfectly. We've then moved higher, and then we've consolidated those gains, and then we've moved higher again. Now, what's interesting is if we go over to the left, this is a 61.8% retracement, and although it popped up through this line a few times, it didn't actually close above it until yesterday, where it closed above it. And of course, like gold and silver today, is marched steadily higher, and we're in shouting distance of the $1,000 mark, where I would expect there to be a bit of psychological resistance initially anyway. The target from a technical point of view from here would be the 78.6 Fibonacci, which is around the $1,012 mark, with some interim resistance at that 1,000, as I said. On the downside, support comes in at around where this ascending trend line is, which is around the 973.5, 974 region. One thing to note though, again, is that platinum is moving towards its overbought territory. We can see last time that it was up here, it had a bit of a nasty pullback to that 200-day before bouncing again. But certainly it's not drastically overbought, but it is moving in that direction. So as far as momentum traders go, maybe just keep an eye on that. Although I will be the first to admit that it appears to be political events on Capitol Hill and in Asia that is perhaps driving prices in that setup more at the moment. Let's move over to palladium. The metal that I say just keeps giving, has a dual industrial purpose, is found in the catalytic converters of motor vehicles, much as platinum is. So that gives both of these precious metals a somewhat different supply-demand dynamic than just purely silver and gold. Although I will admit, actually, they do use a lot of silver in electronics and things as well, but certainly not to the extent that we see here. Anyway, if we're looking at palladium, again, it's almost like a broken record. Consolidation breaks higher. We can see here consolidation breaks higher, and we've consolidated here above this line, this wedge pattern yet again. This is around 919. We broke out of this last week, and we've been consolidating in a very nice fashion above this line. From a short-term point of view and a technical perspective, as long as this sort of 919, 920 region holds, there would be no particular reason to be too worried about palladium. Support appears at the 100-day moving average, which is around the 848.50 region, followed by this ever so long trend line here that goes back well into the early part of last year, which comes in around today on my notes, 820.50, and then of course we have the 200-day moving average here at 801.33. So quite a lot of wood to chop in palladium, to be honest, on any pullback to turn this bullish trend around. Again, the RSI is sort of sitting towards overbought levels, but again, I'm not too concerned because we have spent quite a lot of the year up here, and the pullbacks aren't really that aggressive thus far. So from a technical point of view, it still looks like all systems go with palladium. Let's pop over to copper. Again, another beautiful picture for commodity bulls. This copper has consolidated around this sort of 285 area where it broke through a couple of weeks ago on that last big dollar sell-off. It's actually consolidated quite well and then proceeded to start moving higher again, along with most other precious metals and industrial metals such as zinc and aluminium, which have particularly zinc has been on fire. Support now is at this 284.75 area, as I've marked. We have a target here, if I just squish this chart up a bit, of around 3.3. Now we need to go back an awfully long way, all the way back into 2014 to see these previous highs, but that would be potentially the next technical target, having broken through this sort of 284.75, 285 region. Down below we can still see the 100 and the 200-day moving averages sitting around sort of 265, 268, which would certainly provide long-term support. We haven't been particularly through the 200-day moving average for a very long time. Having said that, I do need to bring your attention towards the RSI, which is now moving into solidly overbought territory. We have been loitering up here, but we haven't had a meaningful correction in it. So this looks rather exponential, this rally here over the last 2 weeks. So maybe a little bit of caution is warranted for the short term from a technical point of view on copper. Although it can stay in a bullish trend, I'm not denying that. There is potential perhaps for a bit of a corrective pullback just to mollify those excessive long positions that are around in the futures market at the moment. Let's move over to energy, which has been quite interesting, obviously with Hurricane Harvey landing in Texas and parts of Louisiana. The situation is still not too clear over there, to be honest. You see a lot of coverage on the TV showing floating cars and people being rescued in boats, but we've really not got much concrete detail, and that says to me that it's still a very dynamic situation there, and that the authorities themselves have just not had a chance to get a proper assessment of the extent of the damage there. Now, for shale, I don't think it means too much at the moment. Eagle Ford was in the path, but certainly the Permian Basin, that certainly wasn't expected to be affected nearly as much. What has happened is they've shut down a lot of the refining capacity for distillates such as gasoline and jet fuel in Texas. And Texas has about 16% of the United States' refining capacity. Now, those refineries aren't necessarily damaged. They have been shut down due to the weather, and I would suggest that the workers have not been able to get back again to see if there is actually any damage to those refineries. If there isn't, then, and if there's no damage to the pipeline infrastructure, then the supply and demand imbalances on the distillate side could be rebalanced quite quickly. We don't know that yet. So if there is damage, then that whole dynamic may change, and that will be make for quite an interesting weekly commentary next week. Just looking at natural gas, it has risen a little bit here as traders were worried about natural gas being disrupted from refineries and pipelines in Texas. But the move itself is still, I think, fairly shallow. We are definitely still in this consolidation range. If I look around here, this 3.1 level down to this around 285, 275 region. 285.60 is the first major support. We have a double bottom there, and then this is going to be the more longer term support here, where I'm circling around this 275.5 level. Resistance comes in at the 100-day moving average, which is around 302, and then of course the 200-day moving average, which also coincides. Let's stick a line on that one, shall we make it a bit clearer? Which also coincides with these 2 or 3 little tops here. It's not quite perfect, but got enough for government work. We can see the 200-day moving average here around 308, and then this line is around 310, and we can see 1, 2, 3, 4 tops that have come in at around about those levels. So natural gas for now does still look like it's in a solid sideways consolidation pattern with no particular strong trend there. Let's move to Brent crude. Brent crude continues to trade constructively from a technical basis. It's not oversold, it's solidly neutral. The premium of Brent crude over WTI has moved out now to multi-year highs, touching I think $5 today. We'll talk about WTI's price action in a minute, but taking crude in isolation, forgetting Hurricane Harvey, etc., the price action itself is actually still very, very constructive. Having moved up from these 44 lows, we are still consolidating here in a nice sideways pattern. We have support around our 51.20. Resistance at 52.65, 53.45.50 on the top side would open up a move towards this 55 level. Must hold support at the moment would be the 49.8 sort of 50 region. Why is Brent trading so much more constructively than WTI, you might ask? Well, that I think the answer to that lies in a couple of things. It has a much higher delta to what's going on with the OPEC/NOPEC production cut news, and it also has, how shall I put this, a much well, lost the words there, and it's in the middle of a commentary. That's it. Futures backwardation. It has futures backwardation. There we go. Sometimes I do this on TV as well, but I've never done it quite as badly as I've just done it there, where I've just completely lost the train of my thoughts, and I actually did have it written down as well. There you go. It happens to the best of us. I'm back on track now. So very high delta to whatever's going on with news as regards the OPEC/NOPEC production cuts. And we've seen that some of the major Libyan fields have had to be shut down much longer than everybody had expected over the last couple of weeks. But most importantly, the futures have moved into backwardation. That means that the price for spot immediate delivery Brent is higher now than the price for forward delivery Brent, which is lower. Without going into the details, this is actually a very bullish formation in the futures and in the oil market, and it's a situation we have not seen for many years now. It's mainly been in contango, where spot is lower than the forward futures market. This is, I think, perhaps a reflection of the falling inventories around the world, and perhaps that OPEC's and NOPEC's production cuts are starting to finally take place, and hence Brent is actually trading reasonably constructively from a technical point of view in a sideways consolidation pattern after a good rally. Right, now that I've got my my thoughts back in place, let's move to WTI. Now, this is a story of two halves, isn't it, really? I mean, WTI's price action is certainly not constructive when compared to Brent's. We have had a negative technical picture here, where we have broken out of this symmetrical triangle to the downside, and the resistance for this triangle now, the breakout of this triangle, which is around sort of the, let's have a looky here, get it exactly right for you, around 47.25 is now intraday resistance, followed by the other side of the triangle, which will be up and around, let's have a looky here, around 47.90, 47.95. So those will be your initial resistances. Why is WTI looking so ugly when Brent is actually looking not so bad? Well, the answer here lies apparently in Hurricane Harvey. Now, it would be counterintuitive to think that a massive storm shutting down all of the refining infrastructure in Texas and parts of Louisiana would be bearish for oil prices, but that's not quite looking into it deep enough. There is plenty of oil still around in the United States. It's not actually disrupting the production of oil per se. The Gulf of of Mexico, which shut down parts of it, recovers very, very quickly after these storms once they pass through. The problem has been that the refineries themselves cannot take that oil in, refine it into whatever they do, and then produce things like gasoline, jet fuel, and distillate. So we've seen the price of gasoline futures, for instance, race up by nearly 4% over the last couple of days. Yesterday morning it was up at 7% at one stage. And there's also concern about being able to deliver these products from the Texas coastline, where most of these refineries are, to other markets in the United States. And so, although we do have some terrible weather issues down in Texas, the effect of it has been on the downstream refined product side of the equation and not on the WTI side of it. And in fact, what the market is saying is that there will still continue to be plenty of oil produced. There will be just no refineries to refine it, and this is going to push up inventories, and thus we've seen WTI fall. The next level after this will be around, and I haven't drawn it on to keep the chart clean, around the 45 level, and then there's a double top up here around 48.70, and that will now be quite formidable resistance. We can see a series of lower highs here right through the mid part of August. Let's move on to the softs now. I'm sure I've spoken long enough about energy. Sugar has had a fantastic run over the last week yet again. This is all about Brazil, and Brazil being the largest producer of sugar in the world. What they've done is brought in a 20% import tax on ethanol. Thus, sugar producers in Brazil will now use that sugar cane that they've grown and send it off to these ethanol plants to be broken down and made into biofuel, instead of refining it and sending it out across the world to put in our coffees, food, and generally harden our arteries. Reduced supply of sugar on the world markets equals higher sugar prices. And in fact, we've seen a rally of about 8% this month. There are also some large shorts on the futures exchanges. The Commitment of Traders report, backward looking last week, showed that those shorts had increased yet again, marking, I think, a 1-year high. So there's still plenty of people out there who are also short and probably getting squeezed by this rally. So where's our first resistance here? Quite clearly the 100-day moving average at 0.1453, and then this previous high at the start of August, which is 0.15 or 15 cents a pound, depending on how you want to talk about it. In the meantime, on the downside, long-term resistance support continues to be 0.1250. Let's pop over to corn, where the picture is not looking so rosy. As we can see here, it's looking pretty ugly. The target that I mentioned last week was, I think, 337.60. We've blown through that target completely, and we're now trading below it at around 335.10 a bushel. I think that's what they call it. Let me just squash this chart up to give you a better picture of everything here and to show you what I'm thinking. Okay, so this is all about predictions of harvest sizes, and like wheat, the prediction in the markets is that it's going to be a bumper corn crop this year. The USDA has 61% of the crop in the United States is superior or very good, which apparently isn't so good for prices. But anyway, no denying it here. We've been in a solid downtrend since the start of August, when some of these predictions started coming out. No end in sight really from a technical perspective. We seem to drop, consolidate, drop, consolidate, drop, and then consolidate. I'm not seeing anything here that says to me that that technical picture is changing for now. We are approaching a small support zone, this 330.60. 3.3170 region, which is a series of previous lows from late last year, And perhaps the other thing is that traders really need to be watching here is that the RSI now is moving into pretty solid oversold regions. We've not really had any pullbacks in corn of late, and in fact they've been adding shorts on the futures exchanges. So perhaps there is the possibility, looking at this RSI, that there could be a short covering rally. Nevertheless, I think looking at the technical picture here, we would have resistance around this 340.80, then this 343.50, and then around this sort of 348.30. There'll be a lot of wood to chop, so I'm not quite sure how far that rally would run back. Time will tell there. But I think as long as the predictions are still going on, bumper harvest, then corn may well still be suffering. Moving on to soybeans, let's just squish this chart in a bit. Should actually be following corn and wheat to a certain extent, but it is actually used as a substitute for canola, and canola prices have been rocketing, and I'm not quite sure why that is, but when canola rockets, then using cheaper soybeans as a substitute becomes appealing, and this is what's been causing this rally over the last week or so. We can see quite clearly here that resistance would be around the 100-day moving average, which is at 950.55, and this ascending trend line here over the last week or so has held the pullbacks pretty well. It held this one too. We didn't close below it, but we can see today that should this continue, we will close below this short-term trend line support, and that may be foreshadowing that the party is perhaps over for now on soybeans. We'll get no help from the RSI. It's solidly neutral. And as I said, the 100-day moving average would need to probably break and close above this region in order for soybean bulls to get more excited. So for now, it looks like the soybean rally may have run out of steam should the price action remain as it is today here on Tuesday. Finally, we move to wheat. Like corn, vast predictions of bumper harvests globally, not just in the United States. Has seen corn under the cosh. I can just try and squish this up so I can get some. There we go. My 200-day moving average. Surely, I guess there's no real good news there. I'm not quite sure how to paint this one. It drops, sort of consolidates bearishly, drops, consolidates, drops, consolidates, drops, consolidates, drops, and sort of consolidates bearishly here as well. Key support here is of course this line at 393.70. A daily close under that would suggest more pain ahead. Realistically, I think the first resistance here would be the 200-day moving average at 424.08. I think we're pushing our luck, drawing a downward sloping line there. We do have a couple of tops here around this sort of 405, 406 level as well. This is driven by supply and demand. It looks like there's going to be an awful lot of supply and perhaps not enough demand. The one redeeming feature again about this picture, I would suggest, is that the RSI at the bottom of this chart is now very, very oversold, and it has been for a while. So maybe there might be some adverse weather conditions. Remember, Hurricane Harvey won't affect any of these commodities. They're all mainly grown in the mid and the north part of the United States. Things like cotton have been rallying because they are grown in Texas. So we can't look for any adverse weather to perhaps give us a boost, but maybe just the weight of short positioning now in wheat could lend to perhaps a short covering rally. But again, a bit like corn, it has an awful lot of wood to chop to break out of this fairly solid downtrend. Well, that's it, everybody. I hope you've got some use out of that. Thank you very much for listening in. Sorry about that little bit with the Brent. Happens to the best of us, but I got there in the end. So I wish you all good luck and good trading in the week ahead. And thank you for tuning in.